This is a new series. We found that there was a gap in the market in terms of this type of knowledge, in terms of getting very genuine, authentic ideas in terms of how to approach investors as a startup founder in terms of structuring your capital needs. So here today we have Geoff from Cava Capital. Geoff, how about we start off by just you giving us a little bit of intro about yourself and Cava Capital and the focus of your investment firm.
Sure, thanks again, appreciate it. Name is Geoff Schneider. I'm the founder of Cava Capital, which we are a 16-year-old boutique venture capital firm. And so we've been, over the last 16 years, we've been focusing most of our energies on sort of digital economy companies. And through the early part of Cava's history, we did a lot of things that ended up being companies that we either got involved with at the earliest stages or companies that we started to found ourselves. We just found that there were holes in the themes that we were looking for. And so being former entrepreneurs, you're always an entrepreneur once you're an entrepreneur, but we found that some of the best ways to attack the problem set was to go and start companies ourselves. And so the past 13, 14 years, we've worked with a bunch of investors, obviously entrepreneurs, and we've built about 20 companies. And with that said, we've invested in about 50. So early stage investing, in our opinion, is much more about just the dollars you write or the checks you write. It's really about applying your domain or operational expertise to those businesses. And so we look for specific businesses where either the founder is looking for a technical or business co-founder, one or the other, and is also looking for money at the same time. So if you think of us as sort of this hybrid between entrepreneurs, being entrepreneurs and operators, and investors, that's what investors. Yeah, and we take it pretty seriously. We've got involved, as I said, in 5 companies which we've started, and another 15 or so which we've in essence partnered with. So right now, the kind of things that we're looking for, to be honest with you, our focus, in essence, is we're a relatively small group. We've got 4 partners and a couple of other administrators, but we're really looking for those kind of businesses really focusing on the digital economy, which is a big, broad cross section, but things that ultimately, play around our themes, which, I can go into a lot of detail, but they have to do with the millennial consumer and the Gen Z consumer and how digital natives are now in a world where, all the applications, all the business processes, everything they do, even consumerism is focused on, on these folks. And it's the biggest demographic shift that we've seen since the baby boomers in almost 50 years. So we look at this intersection between digital economy and consumer lifestyle and wellness. And so we've done a number of deals in that space. So it's been a hell of a run. For the first, I'd say 14 years, we were doing most of our deals in SPVs. Individual deals, individual funds in essence. And now we're out raising a pretty substantial fund, a $100 million fund.
Is this going to be the first fund, like Fund 1, Fund 2?
No, we don't call it Fund 1. We actually call this Cava Studio. Because again, whether you do one deal or whether you do 100, it's the same principle, right? You still have to start the fund, you still have to fund it, you still have to maintain it and do all the investor relations and everything else you would do as a fund manager. But at the same time, you're working with the company. So whether I had 6, 7 going at the same time, it's like running a fund. So technically it's the first pooled capital vehicle, but from a fund standpoint, it's not the first time we've ever managed any capital. So I think the key here is that this owner-operator approach we call Studio is really the differentiator. It's a deep dive. It's a partnership with entrepreneurs. We, in almost in all cases, get founders' capital, so almost like common equity. Even before we invest our dollars in preferred equity. And we do that because we really do treat it as, an operation or a co-founding role. We will often take executive
hands-on roles.
Yeah. So
That's interesting. Yeah, actually, it's funny. 6 months ago, we did our first kind of venture builder model where we actually partnered in with the company via an equity approach to
Sure.
kind of have this operator mindset, but also investor mindset with them as a business.
Yeah.
It's been interesting for us because we're trying to kind of diversify a little bit, not kind of only do professional service work, but also have some vested interest into some of the more promising startups that we get to work with. So we're kind of like a studio ourselves, but we don't have the capital yet to invest like you do. So
Yeah.
well, one day I hope.
It's the holy grail. I mean, I have a services background. Like, so I early in my career, I worked for a number of services firms, and I actually helped, one of those firms, I helped co-run the internal venture capital fund, or in essence, the corporate venture capital fund. And we did it specifically to do what you just mentioned, which is we were a services firm. We were obviously getting paid for building out, strategies and other specific technical aspects of our clients' needs. But we wanted to double down in a sense and share in the upside development of the company's enterprise value. And we never led or anything, but we got very close to the venture capital and private equity worlds. And it's hard to meld those two, because if you're not in both, or if you're in both camps, but you really don't have a strategy per se, it's a little bit like throwing darts, right? I mean, so the business models can meld, but it's more often than not that they don't. So
one of the things that we notice is that it's hard to take on too many of these type of things, because we're starting another one, and what we see is that, like, sometimes we're invested in these companies and we want them to succeed, and if they start struggling, then it's just like our opportunity cost at the same time that we're losing out here. So like, if we spread ourselves too thin at the same time, then it becomes difficult to make sure that we could have success in each one. So we try to stay focused. So yeah, it's very interesting. I mean,
sounds like the entrepreneur's dilemma as well, right? Where do you spend your time? Right?
Where do you spend your time? Yeah, exactly. Cool. Thanks so much again for joining us. Had some kind of talking points I wanted to go through with you. Wanted to kind of learn a little bit first in terms of your relationship with CEOs. So like, you have a lot of founders, co-founders of companies that come to you or looking for capital. Let's say, like, hypothetically, you're meeting them for the first time. Just for the people who are going to be listening into this, what I want to ask is, like, what is like the one thing you wish that CEOs would ask you more, and that that you've seen that they don't start off with, or they don't approach it correctly initially?
I'd say that's pretty simple. And that's, what can we, meaning Cava in this particular case, what can we bring to the table to change the game? Right. I think, and this is generic, but for the most part, CEOs are out looking for money, right? That's why they're doing it. And that's fine. There's plenty of opportunities to raise capital, whether it's family offices or direct investors or institutional venture capital players or other hybrids. And if all you're looking for is money, then you're going to be solely focused,
on getting the money,
on that in your conversation. But the reality is, I think CEOs, the best CEOs we've ever worked with, and one of the reasons why we work with them multiple times in some cases, are those who understand that being a CEO is about building the right toolbox, right? It's about building the team and building all the components that you may not bring to the table. So understanding what a company needs, when it needs it, and how it needs it is really the focus area of what I think is a high performing CEO. So how can I surround myself with people that are in many ways smarter than me, but certainly can bring things that I can't bring? Because at the end of the day, it's all about resource allocation, right? So whether that resource is money, or whether it's time, or whether it's people, you've got to be able to understand the bigger picture. And I think most entrepreneurs, especially young entrepreneurs who haven't been through this, they think that they've got it all, right? And they just need the money to execute it. And maybe some of them do, and that's totally fine. But they very rarely ask, so how can
What do you bring to the table?
yeah, how can you significantly change the vector here, right?
Mm-hmm.
Money's going to be one answer, right? But it's not the whole answer, especially in our case. But that's the one question I wish I got more. They just don't ask it very often.
Why do you think that is? Is that they don't want to look like that they don't know all the answers, and they don't want to come off looking stupid or silly, or that if they come to you asking that, then they might feel like they're unprepared or something like that? Like, what are your thoughts?
I don't know what the reasoning is. Maybe it's just being not being afraid to show your cards. But I don't think that's a weakness at all. I mean, if you're a great CEO, you should be saying, "Hey, look, here's what our plan is. Here's how I'm going to get there. Here's how much it's going to cost, and here's where I'm deficient in tools, right? Resources, or capital, or whatever, and
know-how, or whatever.
Yeah, this is where I need help, right? And if are you guys, is this something that you guys do? It's a very simple question. I don't think it shows weakness at all. I think it's the proper question that a CEO or a founder should be asking. Where can you plug holes? Because I mean, there are very few exceptions, and sometimes in the Valley, you're able to sort of assemble an ace, sort of an all-star team from day one, and command the attention of 15 different venture capitalists and raise as much money as you need, and you're off to the races because you're a proven entrepreneur. But that's one out of thousands.
So. Right. Okay. That's very interesting. Yeah, I mean, I totally understand the mindset. It's like I think it's a common thing that isn't brought up enough, as well as like another one which I want to ask about is about capital needs. Like some founders go to investors and they ask for more capital than they need, and they haven't planned their budgets accordingly or something like that, and they ask for more than what is required, and that becomes a problem for them maybe at that time or later on. Like, what are your thoughts about like raising too much capital as a CEO?
Well, I think it's a two-way street. So, excuse me, but it can happen either side of that transaction. So the founder can be, you're absolutely right. The founder could say, hey, I need X amount of dollars. And, in essence, it's just a big slush fund, right? I mean, and I don't mean that negatively. It's just they don't really have an idea of what they're trying to achieve between the day they raise capital and, let's just say, the next milestone. I mean, having a bit of an understanding about what the pattern here is going to look like, I think is a important piece. So, I'm going to raise my seed here, or my Series A, or whatever you are, and at whatever point, and we want to achieve the following 5 things. And we think by doing that, we can improve our valuation and improve the chances that we get a larger round of capital, which is going to ultimately take us to the next milestone, which we think ultimately takes us to the promised land, right? That's what we're trying to do here. It's just it's just a natural, process-driven, non-emotional way to look at building a business. Capital is a gigantic portion of this, right? So, but having the right amount of capital at the right times is going to do 2 things. One is it's going to focus the energies around the right set of milestones. It's going to limit dilution, right? I mean, that's, from a founder standpoint, I think important. I would certainly hope so, because
I would say so, yeah.
Yeah, and then I think there's the third benefit, which is I think it installs discipline. So focus is one thing, discipline's another, and discipline is ultimately about outcomes, right? And I think being responsible for outcomes is a great way to not only demonstrate to your capital providers that you're worthy of being trusted. I think it's important to your employees that you're worthy of being trusted, and that you've taken, a very pragmatic approach. Now, there absolutely has to be an amount of cushion, I guess is the right word, that you need to build in. And that's okay. You can say, look, I don't want to ever have less than 6 months of cash in my account, because for the sense of, not understanding what the funding environment may be at the next time. Who knows? The world could be in another COVID crisis, right?
Yeah.
Or you always have to plan for the unplannable, right? And so the worst thing you want to do is be caught in a situation where you have too little cash, and then the people on my side of the table can take advantage of that, right? They know you're running out of cash. They're going to drive a harder bargain and better valuation for themselves. That's not a good place to be. So I think there's a little bit of a give and take here. The other thing I see happen a lot is that venture capital, especially larger venture capital firms, who, they've raised very large sums of money, and if you do the math, they have to deploy it, and they have to deploy it in relatively large chunks. A $3 million investment for a $1 billion fund it's just hard, right? So they've got to get 20, 25, $30 million, if not more, into that business at some point. And so they often will ask you to take a larger amount of money up front and give you excuses like, hey, you're going to need it, and there's some truth to that. But at the end of the day, they're trying to deploy capital. And so I think a founder has to be a little bit wary of that. And that just creates this mentality where, which I've seen often, happens a lot in the Valley, but where it's this, unicorn or nothing approach. Because now the valuation creep starts to happen early when you haven't really done anything. And all of a sudden, the only real exit is some, super inflated valuation. Well, that's great if you're chasing it's a zero-sum game. It's either a unicorn or nothing. But the reality is most companies don't make it to unicorn status. They never will. It doesn't mean they're bad companies. It doesn't mean they can't return immense amounts of money to their shareholders and ultimately for themselves. And if the game is to build a really good business, there's nothing wrong with a couple, $100 million exit. If you entered in at the right valuation, you can make 8-10 times your money. Well, sometimes that gets thrown by the wayside from the minute it starts, because they throw so much capital into a business so early. Valuation's already at 100 million, so it's crazy.
It's very overvalued. Yeah.
And from my perspective, from an investor's perspective, and maybe I'm just doing this because my perspective is such that I don't want to deploy lots of capital into unicorn chasing things. If we get a unicorn, that's fantastic, but it's not because we started from day one thinking that. It's because the business earned that, and ultimately we're going to keep investing into that. So I just find it's disingenuous on both sides sometimes to raise too much capital.
Okay, awesome. And I know you mentioned earlier in the call that you do a lot of hands-on work with some of all the companies that you have in your portfolio. Like specifically, like once you invest money into a company, what kind of hand holding do you do with the founder, or like how involved? Like, can you give us some examples of how you monitor those funds that are being deployed?
The funds, or the types of things we do through Cava Studio? What are you specifically asking?
Well, no, sorry, specifically to the startup itself. Like when you invest into them, what kind of hand holding do you do?
Okay, yeah, and I'll try to circle it back to how we monitor the spend of capital as well. So, I mean, look, every company is different, right? So it depends. If we're starting it, it's one thing, right? And very often myself or one of our partners will, or our operating partners, we have a pretty diverse set of operating partners who we've built businesses with that want to build other businesses with us. And so we'll install them, or they're already installed because it's their business. In that CEO role or COO role. We have one right now in Southern California. It's a functional beverage where one of my operating folks is playing the COO of the company, and she's doing an amazing job. I mean, the company would not be where it is without her. And so that's, everything from helping to form the company, if that's where it is, to looking at the market opportunity, to really defining and acquiring, what the needs are, the human capital needs are, the capital needs are, the product strategy, software, hardware, depending on what it is. I get unbelievably involved in the fundraising. So aside from putting our own money in, if we want have a relatively diverse set of investors, I'll get involved in fundraising and literally in some cases take it over. I'm working with another studio company right now where I'm responsible in the company for fundraising, even though we put our money in. So,
really? Wow. Okay.
oh yeah.
That's
So it
interesting.
takes it off the CEO's shoulders, right? Because that CEO has got to be focused on delivering the product architecture, right?
Yeah.
So I take over that. We do, standard company or a customer building. So in the case of a company that's looking to sell its solution or get beta clients for a solution that they're working on, we'll make massive introductions to, different companies in that space. If we know the space very well, of course, we wouldn't have done the deal if we didn't. So we'll make introductions. We'll even, run through the sales process. We help them with IP building, product building. We have hardware, software, relationships that can help that. So the concept is to accelerate, that business building or de-risk the company through those really formative years or months in some cases, right? And
critical periods when they get the capital, for sure.
Totally, because you can get so distracted with like nuance, to have one person be responsible for everything from, is my Delaware organizational documents in the right place to fundraising, to product build. And it's great. Like that's what CEOs are supposed to do. But if I can help take some of that off the table, or my team can help, then that's what we're going to do. And then we've helped build rebuild or build the models in, for how the business is going to operate, help staff the company. I've got human resources relationships right on our team, multiple year human resources professionals. We've got finance people, we've got investor relations people that we have relationships with, and we literally can come in and deep dive with the company. So it's a little bit like, you're technically focused,
you got a triage team. Yeah,
we have a team. Yeah. And we bring I don't want to call it like there's no formula, but it involves all those different things. And then at the end of the day, we help them monitor their progress, right? And we install discipline at both the board and I think executive team level to monitor, how they're achieving their goals versus the spend of capital. And so again, back to the earlier conversation, so they don't get in a position where they're desperate for money because they've either overspent or underdeveloped, a certain set of resources. So
let's talk about that. It's a common mistake that founders typically make. I'm curious to get, you touched upon it before, but why do you think that happens? Like, how can they plan better in terms of their fundraising, the fundraising timelines? Like, how can they be more prepped or have the right mindset towards this?
Experience. I hate to say it, but it's one of those things where sometimes, and it is, but you learn because you've gone through it once or twice, right? And I'll give you an example. I can't tell you the company because they're still a current portfolio company, but one of my most significantly senior leadership teams is, they are unbelievable. Great execution team. They built another company that was sold for close to $1 billion. Okay, so prior to this.
Okay. All right.
So very successful company, very big exit to a very well-known name.
Okay.
They learned through that process how bad it can be by not really understanding not only the funding process, but the whole the litany of things that have to be done through that process. And I mean that because they got diluted so badly. So even with a close to $1 billion exit, and look, they're not poor, they're not going to be starving, but they ended up with, single digit percentages of the company. Why? Because throughout the process, they didn't understand various checkpoints, or certainly maybe raised institutional venture capital money way too early. And when you get big institutions and multiple institutions in your company and things start to click like that, as I told you earlier, and maybe there's too much money or there's too much attention paid to the wrong things, all of a sudden you need more money and you keep diluting and diluting and diluting. And that's what happened here. So they swore with this new company, which is also a $1 billion plus company today, and I think will be a mega $1 billion company when it's all said and done.
Wow.
That wasn't going to happen to them. So they never took institutional capital until recently. And that's basically 12 rounds into their company. They've raised $300 million at this point, and have executed flawlessly. And now the founders own well more than half the company. So it's
lots of experience, lots of
experience. So I think that's the number one thing that comes. But working with this is a little bit of a commercial, but working with folks like us or others who have deep experience and are really founder led and are founder driven, we have no pretensions about wanting to make the founder or the team in this particular case very successful, both financially and and spiritually in that sense, right? So that we want to help them build their dreams, their companies. Now we're going to participate along the way, but we feel that if the founder's successful, we're going to be very successful in this particular case. So
yeah, it's a real partnership.
And that's the way we approach it.
No, that's really interesting. I know you also invest, B2C and B2B companies. Talk about like consumer companies that you invest in. You mentioned previously when we were talking earlier that you find that consumer companies or companies that have a B2C offering spend sometimes too much money marketing early, and they burn through that cash quite quickly. And I'm just curious, like, why do you think that happens, and how can CEOs avoid it, or like kind of like learn from this?
It's not, marketing early is the right way to put it, but it's not about, it's spending the wrong marketing dollars. Like marketing, when you're a consumer company, your end consumer is right there. It's directly in front of you, and you have to market, right? So it's channel management, I guess, is the better way to put it, right? Understanding where you're getting your best customers from, and really having a data infrastructure in place to both monitor and adjust that spend in real time. Now, that seems trite because people say that, well, I do have that. The reality is a lot of them don't. They don't really have that level of sophistication. So if you're going to spend anywhere early on before you really start to spend on consumer acquisition or customer acquisition, make sure your data infrastructure is in place to monitor it literally in real time, because it's there for you. I mean, Google made it easy for you, right? Facebook's made it easy for you. Instagram's made it easy for you. You can do that. And then I think there's non-monetary ways to get a lot of brand building done, or even product building done. And those things have to be, well understood. And I think you have to go into them with a sort of an understanding of pivoting really quickly when things aren't working, or your customer acquisition costs are not where they should be in this particular case. I've seen too many companies, another one of my portfolio companies, not going to mention them, but they got trapped here. It almost cost them the company, number one, but number two, they were able to pivot and immediately adjust and go back to a much more focused set of
leaner. Okay.
Leaner. I mean, focused set of energies around how to acquire customers. And, it's because the industry was demanding it at the time that, just go acquire as many customers as you can. And so they just went out and spent like crazy to do that. And they got customers, but those customers also churned 7 times faster than, the way they acquired their customers traditionally, which got them to there in the first place. And ultimately the CAC was high, and the LTV was virtually zero. So that's just a waste of money. And they burned through almost $15 million doing that. I was like, that was just gigantic waste of money.
Do you think some of these mistakes go, or there's different types of mistakes that happen at B2B focused companies once they get their raise? Like commonly there's some issues around, like maybe you're hiring too fast. They're just growing and like they don't know why they're hiring all these people. Like what are some things you could talk about that you've seen?
I think that's right. I think whether it's hiring internally or staffing up ahead of the curve, right? And that comes with fiscal discipline, like we were talking earlier, right? I mean, there are reasons to do that in most cases. Of course, you're always doing that when you don't have a product, you're ahead of your curve. But I'm specifically talking about now that you have enough people to build the product, but now you're going to hire certain talent. It doesn't matter where. It could be engineering, it could be sales, it could be whatever infrastructure you're building. Well ahead of having customers. And in B2B, it's all about having relationships, beta customers in place or paying customers in place. We happen to love businesses that, in essence, will build their product is built off of an identified and already agreed upon customer need, right?
Okay.
So often the founders come from an industry, they've been trying to solve a problem one way for whatever, numbers of years, and they've identified it as a giant hole. They go out, they get 3 or 4 people that agree with them that are outside their organization. So they become, in essence, not only customers, but sort of
like pilot customers, or
yeah, but not just pilot, but they're also like sort of a product feedback loop, from day one.
Yeah.
And the company gets built on that. And that to me is a really great way to build it. So, but a lot of companies don't do that. So they hire and they build infrastructure and they make mistakes by, over allocating resources to things before it's identified as a need. And so sometimes I think B2B companies also can get caught up in analysis paralysis. You know what I mean? So they'll spend a lot.
Sorry, go ahead. I was just going to say, do you think there's like an innovator's dilemma there as well still?
Maybe, but I mean, I understand it. We've all done it. We want to make sure what we're building is on target, but you can't, research will only tell you so much. You have to do your research, don't get me wrong. But I'd rather do it with customers, to be honest with you, because they're going to tell you exactly what they want, what they're willing to pay for. So I know it sounds pretty simple, but it's often not the case.
No.
I think the other thing that happens is, and it's not the company's faults, but I've seen it happen multiple times. I mean, frankly, we've lost money in businesses when the market shifts relatively radically, a company's inability to wind down that part and pivot quickly is a really, really big problem. Right now, look, sometimes you get caught and you're so single-threaded, there's no way around that. But the most successful companies we've seen pivot on a dime, you know what I mean? And that means you have to have a really great CEO and team, a leadership team that understands and is constantly watching the market and what the macro trends are and how they affect your, in essence, micro trends and what you're working on, right? And if you can't have an intelligent and honest conversation with yourself, your board, and all your employees about something that's happening and be able to make decisions on the fly, it's going to be tough.
And so how do you think that, just out of curiosity, I mean, I'm sure this happened in your portfolio companies, maybe you could talk about 1 or 2 as examples, but like, how does a management team or a leadership team at a company like this be able to have this type of mindset, like that they can advocate behind or stand behind?
Don't get emotionally connected to one thing.
Okay.
I mean, look, we're all human beings. So there's, you get passionate about something and sometimes that passion and energy is great. It's what we are investing in, right? Mm-hmm. But at the same time, you can't be so passionate and so single-threaded that you can't see the rest, of the world. And sometimes shit happens, excuse my French, but perfect example was what happened in, the late, sort of like between 2011 and 2013 in the ad tech industry, right? And there were 1,000 ad tech companies, in 2009, 2010, 11, 12. By 13, that industry had fundamentally changed, like radically, overnight. Well, not overnight, but within a span of a year. And if you were unable to pivot your business, you were gone, literally gone, because it was a commodity. All the agencies started inboarding or in-housing certain technologies. what used to be a managed service business, needed to become a data business overnight, and companies that were ill prepared for that or didn't have the infrastructure or frankly didn't have, the leadership team to make a critical call were dead. I mean, I had a couple of them myself. So, and we tried, but it didn't work. And so, in some cases, we had one or two, and one that's still around that's actually doing pretty well now. They immediately changed their, they laid off half their staff, and it's terrible that had to happen, but that was critical because they got out of a business that was a dying business. We're able to make that, that adjustment and unfortunately decouple the emotion from it and just move to rebuild the infrastructure in a way that reposition the company, hopefully for, a better outcome.
Very interesting. Yeah, I'm sure your portfolio has a lot of experience having gone through all the changes that has happened in this year. I'm sure there's lots of lessons learned there.
Yeah. Well, I've been the CEO of a business, as I told you, we're hands-on. One of the businesses that I started is, grossly affected by the COVID. It's a wellness business, a retail wellness business, right? We've got 5 locations, 4.5 locations, and we were closed for 2 months, literally closed, 3 months. So yeah, went to zero. Yeah. But here we are, and company's thriving, and we literally spent that time. And I'm not saying I'm the perfect CEO, I'm not, but we took that time to look at every single business process that we had, up and down the food chain. The way from the way we checked people in and out of a studio to the way we bought our insurance. And everything in between. And so we said, now's the time. We've been wanting to do these things since we started, and we've never had the time. It always seems to be an excuse for not looking at this or that because you're so busy, And now, so we just took the opportunity to reinvent ourselves and everything that went along with it. Some of it's systematic because of the COVID situation. You have to be complying with state and local laws, but most of it was actually us. It's like, all right, how do managers in their studios actually do their job? How do they do them better? How do we do timesheets? How do we do this? How do we do that? And then how do we use technology to create digital versions of what we do physically? Literally looked at every single thing.
No. Wow. Awesome. Thanks, Geoff. Just last question that I want to ask everybody who's going to be on the series is, what would be your best message that you want to give to CEOs who are going to be raising money later this year or into early next year? Any big messages you want to send out there?
Yeah. Well, this is going to sound counterintuitive because I just talked about how you shouldn't raise too much money, but I think it's going to be rough. We're caught in a weird spot right now. Venture capitalists or other folks who now fund startups or early stage companies, there are plenty of different avenues to look for. So I think my first piece of advice would be, don't just fall into a single lane about how to raise capital. There are plenty of ways to raise capital today. So, whether it's us or anybody like us, that's great. And you can go through those processes. I think the venture industry is deploying capital. There's not even a question about it, but they're deploying capital with both people they know well and in themes that resonate around COVID, which is a little bit like, running to the ball after it's already been kicked to some degree, right? But that's okay. That's this industry. You run towards trends. So if you're on trend, great. If you're not, you may have to look for alternative ways to raise capital, because I think the rest of the traditional VC funnel has been hampered a bit. I think people are being more cautious. The public markets being counterintuitive to the real world doesn't help, because people, who are non-traditional investors, family offices, individuals, might be angels, whatever, can make they feel like they can make a lot of money in the public markets right now, right? And without the risk of 7 years and going out of business every day, which is it's hard. So you have to look wide for different things. Don't be afraid to use the crowdfunding markets. I'm a big supporter of those as a way to supplement your raise, and they've made it a lot easier to do that now. And I mean ways that even things like aggregating your cap table. Before you could do a crowdfund, but you have to put every single investor had to go on your cap table, which is it's really hard. And dealing with $1,000 guy versus a $100,000 guy, it takes the same amount of time. Don't think it doesn't. So, but now you can aggregate all your investors into one user, so that the crowdfunding platforms will often have an SPV or something like that to aggregate them all, and that's helpful. So don't be afraid to use those kind of markets, and really think about the dollars you need to raise. Really think about, excuse me, I'm just having a little bit of a, so really think about how you're going to allocate that over time, and then add 3 to 6 months, right? Because I think now more than ever, it's going to be great to have cash, a little bit of cash on your balance sheet in addition to what you need it for. So I'm not advocating taking way too much money. I'm just saying find your sweet spot, add 3 to 6 months of cash to it, and tell upfront, this is what we're doing, because we want to be in a strong position to raise our next round of capital. And we think it's going to take this to plan for the things you just don't know. And if we go into lockdown again, it's all bets are off type of thing. That's sort of where we started this conversation. So that's the advice I can give.
Awesome. Thank you so much, Geoff. I really appreciate your time. Lots of great know-how here. And
thanks for reaching out. Appreciate it.